In the year 2024, the total market capitalization of the United States stock market reached an unprecedented 223.8% of the nation's gross domestic product. This was not merely a number. It was a monument to hubris, a Tower of Babel constructed from derivatives, pension promises, and retirement dreams. To put this in perspective, for every dollar of actual economic output, every loaf of bread baked, every service rendered, every tangible good produced, there existed more than $2 of claimed ownership in that economy's future. The Buffett indicator, named after the Oracle of Omaha himself, had never screamed a warning so loudly in the history of American capitalism. But numbers are bloodless things. They do not convey the scope of what was at stake. Consider this. In 2024, pension funds held 42.3% of their assets in equities. The 401k accounts of workers in their late 30s allocated roughly 88% to the stock market. The retirement security of an entire civilization rested upon the assumption that tomorrow, and the day after, and every day thereafter, those markets would open. That shares could be bought, that shares could be sold, that price discovery would occur, that liquidity, that most sacred of economic sacraments, would flow. Historical precedent. The longest market closure in modern American history occurred in 1914, when the New York Stock Exchange remained shuttered for 4 months at the outbreak of World War I. The world did not end. But the world was different then. The financial system was not yet a tightly coupled network of algorithmic dependencies. Derivatives markets barely existed. Pension funds had not yet become the primary vehicle for working-class retirement security. By 2024, the average daily trading volume across American equity markets exceeded $450 billion. Each day, nearly $500 billion in securities changed hands. This was not speculation alone, though there was plenty of that. This was the circulatory system of modern capitalism. Corporations used stock buybacks to manage their capital structures. Hedge funds used equity portfolios as collateral for leverage. Insurance companies balanced their long-term liabilities against diversified equity holdings. Banks held trading books filled with equity derivatives, and threaded through it all, like electrical wire through the walls of a house, ran the commercial paper market. $2 trillion of short-term corporate debt that funded the day-to-day operations of American business, with money market funds holding significant portions of this paper. This was the world that existed, a world where the stock market closing for a year was not merely economically catastrophic, it was metaphysically impossible. The system had been designed over decades of financial engineering to make such an event unthinkable. Circuit breakers existed to halt trading when volatility spiked. Exchanges could suspend individual securities, but to close everything for an entire year, that was the province of science fiction, of absurdist thought experiments. And yet, what follows is not prediction. It is not prophecy. It is archaeology of a future that has not yet occurred. We will examine what happens when the impossible becomes inevitable, when the unthinkable must be thought, when the blood of commerce stops flowing through the veins of the world's largest economy. We will trace the cascade, the domino chain, the logical progression from cause to effect to catastrophe to adaptation to legacy. This is the story of what happens when the stock market closes for a year and beyond. Chapter 1: The Catalyst. Day 0: The Announcement. It begins not with a whimper but with a presidential address. The date is unimportant. It could be any date, any year when the conditions are right. What matters is this: a confluence of crises has made the unthinkable necessary. Perhaps it is a cyber-attack of unprecedented sophistication, one that compromises the clearing systems upon which all electronic trading depends. Perhaps it is a geopolitical shock so severe that foreign capital flight threatens to collapse the dollar. Perhaps it is the discovery of systemic fraud so pervasive that price discovery itself has become meaningless. The specific trigger is less important than the decision that follows. At 4:01 p.m. Eastern Standard Time, 1 minute after the closing bell, the President of the United States appears on every screen in the nation. The speech is brief. The language is carefully calibrated. To protect the integrity of our financial markets and the savings of American families, I am invoking emergency powers under the Trading with the Enemy Act. Effective immediately, all securities exchanges in the United States are closed until further notice. This closure will remain in effect for a minimum of 1 year, while a comprehensive review and restructuring of our financial infrastructure is conducted. The words land like artillery shells. 1 year, not 1 day, not 1 week, not until the immediate crisis passes. 1 full rotation of the Earth around the Sun during which no stock will trade on American soil. Historical context. When the Reserve Primary Fund broke the buck on September 16, 2008, falling below $1 per share due to exposure to Lehman Brothers commercial paper, it triggered a run on money market funds. Within 24 hours, investors withdrew over $144 billion from prime money market funds. The entire commercial paper market, the short-term funding mechanism for corporate America, froze. The Federal Reserve was forced to establish emergency lending facilities within 3 days to prevent total systemic collapse. That was a single fund, with relatively limited exposure. Now imagine every fund, every trading mechanism, every price discovery tool simultaneously going dark. In the first 60 seconds following the announcement, electronic trading platforms around the world begin to react. Asian markets, just opening for their Wednesday morning sessions, go into freefall. European markets in their final hours of trading experience circuit breaker halts within minutes. The S&P 500 futures market, which continues to trade after hours, drops by the maximum allowable limit, and then simply stops quoting prices. There is no bid, there is no ask. There is only the void. But these are abstractions, numbers on screens. The human impact begins in the moments after. A portfolio manager at a major pension fund in Ohio stares at her terminal. She has been managing $40 billion in retirement assets for the state's teachers and firefighters. 42.3% of that portfolio, nearly $17 billion, is in domestic equities. Those equities now have no market price, no liquidity, no exit. She reaches for her phone. Her hands are shaking. Who does she call? What does she tell the board? What does she tell the 100,000 teachers whose retirement security she is supposed to protect? A day trader in Brooklyn, a man who has made a modest living scalping small profits on intraday volatility, looks at his account. He has $200,000 in holdings, all in equity. He uses 1 margin, meaning he has borrowed $800,000 from his broker to control $1 million position. That position, as of the market close, is down 8% on the day's news. His broker's risk management system is already sending automated warnings. Margin call. Liquidate positions within 24 hours or face forced sale. But there is no market in which to liquidate. The margin call is a demand for payment that cannot physically be fulfilled. In Greenwich, Connecticut, at the headquarters of a major hedge fund, the scene is one of controlled chaos. The fund runs a sophisticated equity long-short strategy with $50 billion in gross exposure, $30 billion long, $20 billion short. The strategy depends on being able to rapidly adjust positions, to exploit small pricing inefficiencies, to maintain perfect balance. The closure announcement has left them grotesquely imbalanced. They are long positions they cannot sell. They are short positions they cannot cover. Their prime broker, a bulge bracket investment bank, is already on the phone. The fund has 7 days to reduce leverage or face forced liquidation of whatever assets can still be liquidated. But what remains liquid in a world where equity markets are frozen? In normal times, the stock market is a voting machine. In times of crisis, it is a weighing machine. But when the market closes entirely, it becomes something else, a phantom limb. You can still feel it. You swear it's still there, but reach for it and your hand finds only empty air. The Grand Archivist. Chapter 2: The First Ripple. Day 17: The Immediate Fallout. Dawn breaks on day 1 in a financial world that has fundamentally changed. The sun rises, coffee is brewed, morning routines continue, but something essential has been severed. The New York Stock Exchange building stands silent on Wall Street. No opening bell rings. No traders gather. The building has become a mausoleum, a monument to a function it can no longer perform. The first casualty is not a bank or a fund. It is information itself. Without trading, there is no price discovery. And without price discovery, the entire edifice of modern finance begins to list like a ship taking water. Consider the mechanics. A corporate CFO needs to know her company's stock price to calculate executive compensation packages tied to equity. A bank needs to mark its trading book to market to comply with capital requirements. An insurance company needs to value its equity holdings to assess solvency. A pension fund needs to report net asset values to beneficiaries. None of these functions can be performed without a market price. And as of 9:30 a.m. on day 1, there are no market prices. The valuation paradox. In the absence of traded prices, institutions resort to mark-to-model valuation, essentially educated guesses based on mathematical formulas. But these models require inputs. They need comparable company multiples, sector performance, volatility measures. All of these inputs come from the stock market, the system that has been closed. It is a circular dependency, a logical impossibility. You need the market to value the market, but the market does not exist. By day 2, the secondary effects begin to manifest. The commercial paper market, that $1.2 trillion circulatory system of short-term corporate funding, experiences its first convulsion. A major manufacturing corporation has $500 million in commercial paper maturing in 3 days. Under normal circumstances, they would simply roll over this debt, issuing new paper to pay off the old. But the buyers of commercial paper, primarily money market funds, are experiencing their own crisis. These funds typically hold commercial paper as a cash equivalent, a safe, liquid asset. But with equity markets closed, panicked retail investors are flooding the funds with redemption requests, trying to move money from stocks frozen to money market funds liquid to actual cash safe. The funds need to raise cash to meet redemptions. But their holdings in commercial paper cannot be liquidated early without severe losses. It is a classic liquidity trap. The Federal Reserve, watching these developments with growing alarm, convenes an emergency meeting. The parallels to September 2008 are impossible to ignore. Then, as now, the commercial paper market froze. Then, the Fed responded by creating emergency lending facilities. The asset-backed commercial paper money market mutual fund liquidity facility, the commercial paper funding facility. Alphabet soup programs designed to backstop the market, to become the buyer of last resort. The Fed dusts off these old playbooks. Within 72 hours, they announce a new facility, $500 billion in capacity to purchase commercial paper directly from issuers. The message is clear. We will not let the short-term funding markets collapse. But this intervention, while necessary, reveals a deeper truth. The closure of the stock market has not created a discrete, containable problem. It has severed one of the main arteries of the financial system, and the blood is beginning to pool in unexpected places. Every institution that relied on equity markets for liquidity, for hedging, for funding, for valuation, every one of them is now forced to adapt to a new reality. And adaptation in financial markets is never smooth. On day 3, the first corporate bankruptcy is announced. It is not a household name, a mid-sized regional retailer, over-leveraged and undercapitalized. Under normal circumstances, the company might have raised equity capital through a secondary offering or convinced creditors to extend terms by pointing to a recovering stock price. But there is no stock price. The equity is worthless not because the company has zero value, but because that value cannot be expressed, cannot be traded, cannot be monetized. The company files for Chapter 11. It will not be the last. The pension fund dilemma. By day 5, pension fund trustees across America are facing an impossible situation. Consider the California Public Employees Retirement System, CalPERS, the largest public pension fund in the United States, with over $400 billion in assets. Under normal circumstances, CalPERS would hold roughly $170 billion in equities. These holdings serve multiple purposes. They provide long-term growth to match long-term liabilities. They offer diversification. They generate dividend income. But most critically, they provide liquidity. If CalPERS needs to pay out $1 billion in monthly benefits, they can sell equities to raise cash. It happens seamlessly, invisibly, constantly. But now those equities are frozen. CalPERS can still pay benefits from its cash reserves and its fixed income holdings, but those reserves are finite, and every dollar paid out is a dollar that cannot be replaced by selling stocks. The actuaries begin running scenarios. If the closure lasts exactly 1 year, if markets reopen at roughly current levels, if there are no runs on the fund, they can probably manage, but that is a lot of ifs. And pension fund trustees are paid to plan for worst-case scenarios. Across the nation, smaller pension funds face even grimmer arithmetic. A teacher's pension in Alabama, with $5 billion in assets and 88% allocated to equities, has perhaps 6 months of liquidity. After that, they face a choice: suspend benefit payments to retirees, or engage in fire sales of their remaining liquid assets at whatever price the market will bear, destroying long-term returns to maintain short-term solvency. The cascade effect. When pension funds become forced sellers of liquid assets, bonds, real estate, commodities to raise cash, they depress prices in those markets. Other institutions, seeing these price declines, mark down their own holdings. This triggers margin calls and covenant violations, forcing more sales. The closure of one market, equities, begins to poison adjacent markets through a mechanism economists call contagion. By day 7, the initial shock is beginning to give way to a new phase: calculation. The panic has not subsided. If anything, it has intensified. But now, in boardrooms and trading floors and government offices, people are starting to do the math, starting to game out the scenarios, starting to understand that a 1-year closure is not merely a temporary inconvenience. It is a fundamental rewiring of the economic system. And every wire that gets crossed, every connection that sparks and fails, sends shocks through the entire network. Chapter 3: The System Shock. Week 2, Month 1, the cascade accelerates. By Week 2, the financial system has entered a new regime, one that no modern economist has truly studied because it has never truly existed. The United States of 2024 is not the United States of 1914, when the market closed for 4 months during World War I. Then, the market was a sideshow to the main economy, a place where the wealthy played with surplus capital. Now, the market is the economy. It is the mechanism by which capital is allocated, risks are priced, and value is created. Removing it is like removing a vital organ and expecting the patient to simply manage. The credit markets are the first to truly seize. Investment-grade corporate bonds, which under normal circumstances trade in deep, liquid markets, begin to experience severe dislocations. The reason is straightforward. Many of the largest buyers of corporate bonds are insurance companies and pension funds, institutions that typically balance their portfolios between stocks and bonds. With equity holdings frozen, these institutions are dramatically overallocated to bonds relative to their target weightings. Every fiber of their risk management systems is screaming at them to sell bonds and buy stocks, but they cannot buy stocks, so they simply stop buying bonds. And when the marginal buyer disappears, prices collapse. Credit spread explosion. In normal times, a stable investment-grade corporation might issue bonds at 150 basis points, 1.5% over Treasury yields. By week 3, that spread has blown out to 500 basis points. This is not because the credit quality of corporations has deteriorated, though it has somewhat. It is because the market microstructure has broken. Without equity markets functioning, credit markets lose their calibration mechanism. Is a 5% yield on a corporate bond fair? High, low, no one knows. And in the absence of knowledge, investors demand massive risk premiums. The real economy begins to feel the pain in week 3. A mid-sized technology company in Austin, Texas, had planned to raise $100 million through an equity offering to fund expansion. That option is gone. They pivot to debt markets, only to discover that their borrowing costs have tripled. The expansion is canceled. Hiring freezes are implemented. Layoffs are discussed. This pattern repeats across thousands of companies in every sector, in every state. The closure of equity markets has not merely frozen stock prices. It has frozen the entire apparatus of capital formation. The derivative domino chain. By week 4, the true sophistication and fragility of the modern financial system is on full display. The derivatives market, that shadow world of contracts and counter-contracts, begins to unravel. Consider equity options, calls and puts on individual stocks and indexes. On the day of closure, there were hundreds of billions of dollars in open interest in these contracts. These options had expiration dates, some days away, some months away, some years away. What happens when they reach expiration? How can they be settled when there is no underlying market price to reference? The Options Clearing Corporation (OCC), the central clearinghouse for all exchange-traded options in the United States, holds emergency meetings. The lawyers are unleashed. The rulebooks are scrutinized. Eventually, a decision is made. Options will settle based on the last traded price before closure, adjusted by a theoretical model that estimates what the price should be based on corporate fundamentals. It is an elegant solution to an impossible problem. It is also fundamentally arbitrary. A complex mathematical fiction layered over a simple reality. No one knows what these stocks are worth. But options are the simple case. The real nightmare lies in the over-the-counter derivatives market, the $600 trillion notional value web of customized contracts between sophisticated parties, equity swaps, total return swaps, variance swaps, dispersion trades. All of these instruments depend on continuous price feeds from equity markets. Without those feeds, the contracts cannot be properly valued. Margin calls cannot be properly calculated. Risks cannot be properly hedged. The counterparty credit risk that was supposed to be managed through sophisticated collateral agreements suddenly becomes unmanageable. By month 1, 3 hedge funds have collapsed, not because of bad bets or mismanagement, but because of pure operational impossibility. These funds ran market-neutral strategies, long some stocks, short others, perfectly hedged against market movements. In theory, they should have been insulated from the closure. In practice, their prime brokers forced liquidation of whatever could be liquidated: bonds, commodities, foreign equities, to meet margin requirements on positions that could not be liquidated: domestic equities. The funds were killed not by the market, but by the absence of the market. The psychology of frozen wealth. But perhaps the most insidious effect of the closure is psychological. Across America, approximately 100 million households own stocks, either directly or through retirement accounts. These households have, collectively, trillions of dollars in equity wealth. That wealth has not disappeared. The companies still exist, still generate revenue, still employ workers, still produce goods and services. But the wealth has become inaccessible, intangible, theoretical. It is Schrödinger's net worth. Simultaneously there and not there until the markets reopen and observation collapses the wave function. The psychological impact manifests in consumption patterns. Even affluent households, those with substantial liquid assets outside of equities, begin to pull back on discretionary spending. The logic is simple. I don't know how much I'm worth. I don't know if my retirement is secure. I don't know when normalcy will return. Therefore, I save. I hoard. I prepare for the worst. This is the classic Keynesian liquidity trap, but with a modern twist. It is not about interest rates or monetary policy. It is about the fundamental uncertainty that arises when a critical information system, the stock market, goes dark. By month 1, consumer spending has declined by 8%. Luxury goods retailers are reporting sales drops of 30–40%. Auto dealerships are empty. Home sales have frozen, not because of high interest rates or lack of credit, but because potential buyers are afraid to commit capital to an illiquid asset when they cannot access the capital in their liquid stock portfolios. The wealth effect, that mechanism by which rising asset prices stimulate economic activity, has gone into reverse. And unlike a normal market decline where falling prices at least provide a signal, this is a decline into void. No price, no signal, only absence. An economy without a functioning stock market is like a body without a nervous system. The muscles still work, the organs still function, but coordination fails. Signals are lost. The whole becomes less than the sum of its parts, and the organism lurches forward in spastic, uncontrolled movements, no longer governed by central intelligence but by local reflexes and autonomic responses. The Grand Archivist. By the end of month 1, the initial crisis has metastasized into something more comprehensive. This is no longer a financial crisis in the traditional sense, a panic, a crash, a bubble bursting. This is a systems failure, and unlike traditional crises, which resolve through massive repricing, painful but functional, this crisis cannot resolve through price discovery because price discovery has been outlawed. The system is stuck in an unnatural equilibrium, held there by government fiat, prevented from reaching a new steady state by the very intervention meant to protect it. Chapter 4: The New Order. Month 12: Adaptation and Mutation. Humans are remarkably adaptable creatures. Given enough time, we adjust to almost anything. By month 2, the financial system has begun to evolve strange new structures, workarounds that would be unthinkable in normal times but become necessary in this prolonged abnormal state. These adaptations are not solutions, they are mutations, evolutionary responses to an hostile environment. Some will prove beneficial. Others will carry forward into future crises like genetic defects, waiting to express themselves at the worst possible moment. The rise of the shadow exchanges. By month 3, an underground market in equity shares has emerged. It operates in legal gray zones, through private transactions and bilateral agreements. Wealthy individuals with large stock positions find counterparties willing to buy at deep discounts to the last traded price. A $10 million portfolio of blue-chip stocks that might have been worth $10 million pre-closure now trades for $6 million in cash. The discount reflects illiquidity risk, uncertainty risk, and the time value of being able to access capital now rather than 9 months hence. These shadow markets are inefficient, fragmented, and rife with information asymmetries. But they serve a function. They allow price discovery to occur, albeit in dark corners and whispered conversations. Private equity firms, hedge funds with dry powder, and foreign sovereign wealth funds become the buyers. They are making calculated bets that when markets reopen, prices will recover to something approaching pre-closure levels. It is the ultimate contrarian trade, buying when literally no one else can. The private equity pivot. Major private equity firms, sitting on record amounts of uncalled capital, pivot their entire strategy. Instead of buying whole companies, they begin buying discounted equity positions from distressed sellers who need liquidity. Blackstone, KKR, Apollo. These names become synonymous not with leveraged buyouts, but with providing liquidity to the equity-rich, cash-poor. They are performing the function that the stock market used to perform, but with massive friction, enormous transaction costs, and substantial wealth transfers from sellers to buyers. The government, watching these developments, faces a dilemma. These private transactions are technically legal. No law prohibits the private sale of stock. but they undermine the premise of the closure, which was to freeze all equity trading while the system is reformed. By month 4, the Securities and Exchange Commission issues new emergency regulations. Private equity transactions exceeding $10 million must be reported and are subject to a special transaction tax of 10%. The goal is not to ban these trades, but to make them expensive enough that they only occur in cases of genuine distress, not opportunistic speculation. Corporate adaptation, the new capital structures. For public corporations, the closure presents an existential challenge. How do you raise capital when equity markets don't exist? The answer: you get creative. By month 4, a new type of security has emerged, the reopening warrant. A corporation issues bonds with attached warrants that can be converted to equity when markets reopen. The conversion price is set at a discount to the last traded price, compensating investors for illiquidity risk. It is a hybrid instrument, part debt, part option, entirely a child of necessity. These reopening warrants become wildly popular. They offer fixed income in the near term, the bond coupon, and equity upside in the long term, the warrant. Within 6 months, over $200 billion in reopening warrants have been issued, but they also create a new source of risk, massive dilution waiting to happen when markets reopen. Existing shareholders, whose shares are frozen and cannot be sold, are having their ownership stakes diluted by these new instruments, and they are powerless to do anything about it. It is a transfer of wealth from trapped capital to mobile capital, and it will have consequences. Some corporations take even more radical steps. A major tech company, facing a cash crunch and unable to issue equity, announces a mandatory dividend reinvestment program. Shareholders who would have received cash dividends instead receive additional shares. But here's the twist. These shares are issued at the last traded price, which is now 6 months stale. Given that the company's business has deteriorated, revenues down 15% due to the broader economic slowdown, this amounts to issuing shares at an inflated price. It is a stealth capital raise, using trapped shareholders as captive sources of funding. It is also arguably legal, falling into gaps in securities law that no one anticipated needing to fill. The pension crisis deepens. By month 6, the pension fund crisis has moved from acute to chronic. Funds that started with adequate liquidity have depleted their cash reserves. They now face impossible choices. The Alabama teacher's pension, which we visited earlier, suspends cost of living adjustments for retirees. No benefit cuts, politically impossible, but no increases either, even as inflation begins to accelerate. For retirees on fixed incomes, this is a real reduction in purchasing power. Larger funds like CalPERS engage in a massive reallocation of their portfolios. They shift whatever they can from illiquid equities, frozen, to liquid alternatives. This means selling bonds, liquidating real estate holdings, and withdrawing from private equity commitments. But these sales occur in distressed markets, where prices have already been depressed by forced selling from other institutions. CalPERS takes a $30 billion hit to its total asset value, not from equity losses, those are frozen, but from realized losses on forced asset sales. The irony is bitter. The fund would have been better off if they'd been allowed to sell equities at market prices and take their losses there, rather than forced to sell everything else to maintain operational liquidity. Historical echo. This dynamic mirrors, in grotesque exaggeration, what happened during the Great Depression. Banks and insurance companies held bonds and real estate, not primarily stocks, but when depositors demanded cash, these institutions were forced to liquidate their safe assets at fire sale prices, deepening the crisis. The mechanism is the same. Illiquidity in one market forces liquidation in adjacent markets, creating a cascade of collapsing prices across asset classes. By month 9, several smaller pension funds have entered receivership. They cannot pay benefits. They cannot sell assets without destroying value. They exist in a kind of financial limbo, maintained by emergency loans from state governments who themselves are struggling with collapsing tax revenues. The actuaries calculate that when markets reopen, if prices have declined by more than 30% from pre-closure levels, at least a dozen major public pension funds will be formally insolvent, unable to meet their obligations even over a 30-year time horizon. It is not a crisis yet, but the crisis is being scheduled, timed for the moment the freezer door is opened and everyone gets to see what is spoiled. Macroeconomic deterioration. By month 12, as the anniversary of the closure approaches, the broader economic picture is grim. GDP has contracted by 12%, a depression-level decline, though economists debate whether to call it a depression when the cause is policy-driven rather than purely market-driven. Unemployment has risen from 4% to 11%. Corporate bankruptcies are running at 3 times their historical average. The government deficit has exploded as automatic stabilizers, unemployment insurance, food stamps, Medicaid kick in while tax revenues collapse. And inflation. Inflation. Here is where the ghosts of Weimar Germany come to visit. The Federal Reserve, facing a contracting economy and a seized-up financial system, has done what central banks do. It has flooded the system with liquidity. Interest rates have been cut to zero. Quantitative easing has been expanded to unprecedented levels. The Fed's balance sheet has ballooned by $4 trillion in a single year. Much of this newly created money sits in bank reserves, inert and non-inflationary, but not all of it. Consumer prices, particularly for essential goods, have risen by 8% over the year. It is not yet hyperinflation, not yet Weimar Germany in 1923 with prices doubling every 2 days. But it is enough to erode purchasing power, to hurt the poor and middle class, to create political pressure for even more intervention. The paradox is maddening. The stock market was closed to protect the financial system, but the closure has damaged the real economy so severely that the financial system is now more fragile than it was before. Banks have massively increased their loan loss reserves, anticipating defaults. Insurance companies have seen their capital ratios deteriorate as investment portfolios lose value. The payment system still functions. People can still use credit cards and wire transfers, but the lubrication that keeps capitalism running smoothly has turned to sludge. Every transaction takes longer, costs more, carries higher risk. By the time the markets prepare to reopen, we have learned a hard lesson. There is no such thing as a free suspension. Every day the markets remain closed is a tax on economic activity, a friction on growth, a deadweight loss that compounds over time. We closed the markets to save the system, but in doing so, we discovered that the markets are the system, and you cannot save something by destroying it. The Grand Archivist. Chapter 5, The Reopening. Year 1, Day 1, After the Darkness. The announcement comes on a Wednesday at precisely 4:00 p.m., after the time when markets would have closed had they been open. The president's tone is optimistic, almost triumphant. After a year of necessary reform and restructuring, I am pleased to announce that American equity markets will reopen on Monday at 9:30 a.m. Eastern Time. The new trading infrastructure has been modernized and secured. Safeguards are in place. We have used this time wisely to build a stronger, more resilient financial system. The words are confident. The reality is terrifying. Everyone in the financial industry knows what Monday morning will bring, the largest single day of price discovery in the history of capitalism. 1 year's worth of information, corporate earnings, economic data, geopolitical developments, interest rate changes, will be compressed into a single trading session. Every buyer and seller who has been waiting, planning, calculating, will release their orders simultaneously. It will be chaos given form, volatility incarnate. The weekend before reopening is surreal. Analysts work around the clock, trying to estimate fair value for stocks based on the last year's worth of corporate filings, earnings releases, and economic data. The consensus estimate is that the S&P 500 should open approximately 35% below its last traded price. This reflects the economic contraction, the uncertainty premium, and the massive overhang of reopening warrants that will dilute existing shares. But consensus estimates in a market that hasn't traded for a year are worth less than the paper they're printed on. No one really knows. The first microsecond. Monday 9:30 a.m. Eastern Time. The opening bell rings. For 1,000th of a second, the order books are empty. Then the deluge. Computers, trading algorithms, human traders, all submitting orders simultaneously. The New York Stock Exchange's matching engine, upgraded specifically for this moment, processes 100 million orders in the first minute. Circuit breakers trip immediately. The S&P 500 has fallen 11% before most human traders have finished their first cup of coffee. Trading halts. 15-minute pause. The pause is designed to allow cooler heads to prevail, for rational thought to overcome panic. It does not work. When trading resumes at 9:45, the selling accelerates. By 10:00 a.m., the S&P 500 is down 18%. Another circuit breaker. Another pause. This is what circuit breakers are designed to do: stop the bleeding, force a moment of reflection. But these pauses also build pressure. Every minute of frozen trading is another minute for sellers to queue orders, for fear to compound, for the realization to sink in. Everyone wants out, and there are not enough buyers. By 11:00 a.m., when the second pause ends, the market falls another 10% in 20 minutes. At 11:20 a.m., the final circuit breaker is triggered, a 20% decline from the open, and markets close for the remainder of the day. It is the first time in history that markets have closed due to excess volatility on a reopening day. The bitter irony is not lost on commentators. We closed markets for a year to prevent a crisis, and the reopening has created the exact crisis we were trying to avoid. Black Monday comparison. On October 19, 1987, the Dow Jones Industrial Average fell 22.6% in a single day. That remains the largest one-day percentage decline in U.S. stock market history. But Black Monday occurred in a functioning market, with continuous price discovery and established valuation frameworks. The reopening after a year-long closure is categorically different. It is not a market moving from one equilibrium to another. It is a market trying to discover if equilibrium even exists anymore. The next 30 days, volatility as normalcy. Over the following month, markets gyrate wildly. Some days see gains of 8–10% as bargain hunters step in, convinced that the initial selling was overdone. Other days see declines of similar magnitude as forced sellers, pension funds, insurance companies, margin calls from the year of frozen positions, continue to liquidate. The VIX, the volatility index, remains above 60 for the entire first month, compared to a normal range of 10–20. Options markets are essentially non-functional. Implied volatility is so high that option pricing models break down, giving results that make no mathematical sense. By the end of the first month, the S&P 500 has settled at approximately 58% of its pre-closure value, a 42% decline, not quite as severe as the Great Depression's 86% peak-to-trough decline, but achieved in a far shorter time frame and under far more controlled circumstances. The controlled part is what makes it particularly galling. This was not a market panic that spiraled out of control. This was a deliberate choice. Close the markets, freeze prices, try to fix the system, that resulted in massive value destruction when reality could no longer be denied. The wealth destruction ledger. By the end of month 2 after reopening, accountants can begin to tally the damage. Total household wealth in the United States has declined by $18 trillion. Pension funds have lost $4 trillion in value, leaving them collectively underfunded by $2 trillion, even using optimistic assumptions. 401k accounts have lost an average of 40% of their value. A generation of near-retirees has had their plans destroyed. The 55-year-old who was planning to retire in 5 years now faces the prospect of working until 70, maybe longer. The psychological impact is incalculable. But the distribution of losses is not uniform, and this is where the political consequences begin to matter. The wealthy, particularly the ultra-wealthy, had access to the shadow markets during the closure period. They were able to sell at 60 cents on the dollar, take their losses, and move on. The middle class, with wealth locked in employer 401(k) plans and individual retirement accounts, had no such option. They rode the full decline, taking the full hit. The wealth gap, already a source of political tension, has widened dramatically, and when people are angry, they look for someone to blame. Chapter 6: The Legacy. Years 210, the long recovery and structural change. Year 2, the political reckoning. The midterm elections, held 18 months after the reopening, are a bloodbath for the party in power. The opposition runs on a simple platform. They closed the markets. They destroyed your retirement. They picked winners and losers and made sure the winners were their friends. The fact that the closure was presented as necessary to prevent a greater crisis is irrelevant. Voters do not care about the counterfactual, the disaster that was averted. They care about their 401(k) statements, which are down 40%. They care about their pension benefits, which have been cut. They care about their adult children, who cannot find jobs because corporate capital formation has collapsed. The opposition sweeps to power with massive majorities in both houses. Within months, a special commission is established to investigate the closure. Subpoenas fly. Treasury officials testify. Federal Reserve governors are grilled. The transcripts of the emergency meetings that led to the closure decision are leaked to the press. What emerges is a picture of well-intentioned policymakers making decisions in a crisis, but also evidence of regulatory capture, of Wall Street banks influencing the closure terms to protect their own positions, of hedge funds getting advance warning, of inequality in access to the shadow markets. By year 3, criminal prosecutions begin, not for the decision to close markets that remains legally protected as an emergency measure, but for what happened during the closure: securities fraud, insider trading, market manipulation in the shadow exchanges. Several high-profile hedge fund managers are indicted. 2 go to prison. It does not bring back the lost wealth, but it satisfies something in the public psyche, a need to see the powerful held accountable. Years 3-5, structural reform. The markets themselves undergo radical restructuring. A new regulatory framework is implemented with the express goal of preventing another closure from ever being necessary. The changes are comprehensive. 1. Circuit breaker reform. The 3-tier circuit breaker system that existed pre-closure is replaced with a more gradual system. Instead of discrete halts at 7%, 13%, and 20%, markets now implement speed bumps that slow trading continuously as volatility increases. The goal is to prevent panic without creating the pressure cooker effect of hard stops. 2. Shadow market legalization. Rather than trying to prevent private equity transactions during crises, the SEC creates a formal distressed trading framework. Private sales can occur, but they must be reported in near real time, and buyers must post capital to ensure they can settle trades when markets reopen. This legitimizes what happened informally during the closure, but with transparency and fairness requirements. 3. Pension fund liquidity requirements. All pension funds are now required to maintain minimum liquidity buffers, cash and near-cash assets sufficient to cover at least 2 years of benefit payments without needing to sell illiquid holdings. This is expensive. Uninvested cash earns lower returns, but it prevents the forced selling cascade that destroyed so much value. 4. Derivative clearing reform. Building on post-2008 reforms, the government mandates that all equity derivatives above a certain notional value must clear through central counterparties. This doesn't prevent crises, but it makes them more manageable by concentrating risk and facilitating emergency interventions. These reforms are controversial. Markets are less efficient with speed bumps. Pension funds earn lower returns with higher cash allocations. But the political will exists because the memory of the closure and the losses is still fresh. It will take another generation for this will to erode, for the reforms to be seen as costly regulatory burdens rather than necessary safeguards. But that is a problem for future historians. Years 5-10, economic scarring and recovery. By year 5, GDP has recovered to its pre-closure peak. But this statistical milestone masks deeper problems. The composition of the economy has changed. Manufacturing, already in secular decline, has collapsed further. Unable to access capital during the closure, many firms simply shuttered. The service economy has grown, but increasingly in low-wage, precarious forms of employment. The tech sector, which had been the driver of growth, has become more concentrated. The giants Apple, Microsoft, Google survived the closure with their cash hoards intact, while smaller competitors went bankrupt or were acquired at distressed prices. The wealth gap, already wide, has become a chasm. The Gini coefficient, the standard measure of inequality, has risen to levels not seen since the Gilded Age. This has political consequences. By year 7, a new political movement has emerged, calling itself the Reopening Party, promising to redistribute the gains that accrued to those with access during the closure. Their proposals include wealth taxes, forced divestiture of assets acquired during the shadow market period, and even criminal penalties for closure profiteering. The movement gains significant support among younger voters, particularly those whose parents' retirements were destroyed. Intergenerational wealth transfer. Economists estimate that the closure and reopening transferred approximately $3 trillion in wealth from baby boomers, who held most equity through retirement accounts and were forced to take losses, to Gen X and millennials, who were net buyers during and immediately after the reopening, purchasing assets at depressed prices. This is one of the largest involuntary wealth transfers in American history, exceeded only by the Great Depression and the post-Civil War period. By year 8, the stock market has fully recovered in nominal terms. The S&P 500 is back to its pre-closure level, but this headline number obscures two realities. First, in inflation-adjusted terms, the market is still down 15% due to the inflation spike that occurred during and after the closure. Second, the market's composition has changed dramatically. The companies that existed pre-closure are not the companies that dominate post-closure. Entire sectors have been restructured. The creative destruction that capitalism usually delivers gradually over decades was compressed into a few years of crisis. It was efficient, in a brutal sense, but it was also profoundly destructive of established wealth, established careers, established plans. By year 10, economists begin to analyze the closure as a historical event. Was it necessary? The consensus is, maybe. There is evidence that the financial system was indeed in crisis pre-closure, that some kind of intervention was needed. But was a full closure the right intervention? On this, opinions remain divided. Some argue that more targeted measures, suspending algorithmic trading, implementing stricter circuit breakers, temporarily banning certain types of derivatives, could have achieved the same stabilizing effect without the massive collateral damage. Others argue that the system was so complex, so interconnected, so fragile, that only a hard stop could prevent complete collapse. What everyone agrees on is this: the closure revealed the fundamental fragility of modern financial capitalism. We had built a system that was efficient in normal times, but catastrophically vulnerable in abnormal times. We had created markets that were liquid until the moment liquidity was most needed. We had constructed a risk management framework that worked brilliantly until the one scenario it was designed to prevent occurred, at which point it failed completely. Epilogue, year 50, the half-century mark. 5 decades after the closure. 50 years, 2 generations, a half-century removed from the events we have chronicled. By now, most of those who lived through the closure have died or retired. The event has passed from living memory into history, from experience into narrative, from trauma into lesson. And what lessons have been learned? The stock market still exists, of course, but it is different. Trading is slower. Circuit breakers are more aggressive. Algorithmic trading is more regulated. The wild, freewheeling capitalism of the early 21st century has been replaced by something more managed, more controlled, arguably more stable, but also less dynamic, less innovative, less capable of generating the spectacular returns that characterize the pre-closure era. Retirement security has been fundamentally restructured. The 401(k) system, which placed all equity risk on individual workers, has been largely replaced by hybrid models that spread risk across employers, employees, and government. No one trusts that their retirement is secure anymore, so the system has been redesigned to make that mistrust less necessary. Pension funds maintain massive liquidity buffers, so massive that they earn returns barely above inflation, but at least they can weather any crisis without defaulting on obligations. The wealth inequality that spiked during and after the closure has declined somewhat, partly due to progressive taxation, partly due to inheritance taxes specifically designed to claw back closure gains. But the gap remains wider than it was pre-closure. A new aristocracy has emerged, composed largely of those who had liquidity during the year of darkness and used it to acquire assets at distressed prices. These families guard their wealth jealously, invest it conservatively, and pass it down through generations. The Gilded Age has returned, dressed in modern clothes. History does not repeat, but it rhymes. The closure of the markets for 1 year was presented as an unprecedented crisis, a black swan, an unimaginable catastrophe. But was it really unprecedented? Consider. In 1914, the NYSE closed for 4 months. In 1929-1932, the market lost 86% of its value. In 2008, the financial system came within hours of complete collapse. Each generation believes its crisis is unique. Each generation is wrong. The mechanisms differ. The technologies evolve. But the fundamental dynamic remains. Human beings building systems of increasing complexity, mistaking that complexity for robustness, and then discovering, always too late, that complexity and fragility are not opposites but partners. The Grand Archivist. 50 years after the closure, academic papers are still being written. Doctoral dissertations analyze the decision-making process. Economic models try to quantify the counterfactual. What would have happened if markets had not been closed? The consensus answer, based on sophisticated modeling and historical comparison, is sobering. If markets had not been closed, the crash would have been swift and severe, perhaps a 50% decline in a matter of weeks, rather than the slow-motion 42% decline that occurred. But the recovery would have been faster. The creative destruction would have been more efficient. The wealth transfers would have been less arbitrary. The political damage would have been less severe. In other words, the cure may have been worse than the disease. By trying to prevent a crash through a forced closure, policymakers may have actually created more long-term damage than a quick, sharp crash would have caused. But this is easy to say in hindsight, with the benefit of decades of data and analysis. In the moment, with the system on the brink, with panic spreading, with no clear alternative, the decision to close the markets probably seemed not just reasonable but necessary. That is the tragedy of crisis management. The decisions that seem most prudent in the moment often prove most destructive in the long run. The final assessment. So what happens when the stock market closes for a year? The answer, as we have seen, is not a single catastrophe but a cascade of consequences, some immediate, some delayed, some obvious, some subtle. The financial system does not collapse. Central banks and governments intervene to prevent that. But it is damaged, scarred, fundamentally altered. Wealth is destroyed and redistributed in ways that violate every principle of fairness and efficiency. The real economy suffers as capital formation breaks down. Retirees lose their security, workers lose their jobs, and when markets finally reopen, the panic that the closure was meant to prevent occurs anyway, compressed into a few violent days of price discovery. But beyond the economic damage, there is psychological and political damage that lasts far longer. Trust in markets is destroyed. Trust in government is destroyed. Trust in the financial system's ability to perform its basic function, allocating capital efficiently, is destroyed. And once trust is gone, it takes generations to rebuild. 50 years after the closure, surveys show that younger Americans are far less likely to invest in stocks than their grandparents were at the same age. They remember the stories passed down from parents and grandparents of wealth that vanished while markets were dark, of retirement plans destroyed, of promises broken. In the end, the closure of the stock market for 1 year serves as a brutal lesson in the limits of control. Policymakers believed they could press pause on the financial system, fix its problems, and press play again with minimal disruption. They were wrong. A market is not a machine that can be turned off and on. It is an organism, a complex adaptive system, a network of trust and expectation and mutual belief. Turn it off, and you do not get a frozen snapshot. You get decay, mutation, adaptation in unexpected directions. Turn it back on, and you do not get what you had before. You get something new, something wounded, something that will never quite work the same way again. The closure paradox, every subsequent financial crisis, and there have been several in the 50 years since the original closure, is managed differently. Policymakers have learned the lesson. Markets are never fully closed again. Interventions are targeted, surgical, temporary. Circuit breakers are used but sparingly. The fear of repeating the year-long closure is so great that it constrains policy even in situations where aggressive intervention might be justified. In this sense, the closure's greatest legacy might be the closures it prevented, the crises that were allowed to play out more naturally, because policymakers feared the cure would be worse than the disease. 50 years on, the stock market closure of 2024-2025 stands alongside the Great Depression, the 2008 financial crisis, and the world wars as one of the defining economic events of the century. It reshaped capitalism. It redistributed wealth on a scale not seen in peacetime. It changed how people think about risk, about markets, about the role of government in economic life. And it stands as a permanent reminder that in complex systems, the most dangerous interventions are often those that seem most prudent. The most catastrophic outcomes often follow from the most well-intentioned decisions. The markets are open now. They have been for 50 years. The lights are on, trading occurs, prices are discovered, capital is allocated, life goes on. But those who know the history, those who have studied what happened when the lights went out for 1 full year, carry a different understanding. They know that beneath the apparent stability, beneath the daily routine of bids and asks and trades and settlements, there lies a profound fragility. They know that the system we have built, for all its sophistication and resilience, rests on assumptions that can be violated, on trust that can be broken, on mechanisms that can fail catastrophically when subjected to the wrong kind of stress. And they know that somewhere, in some future crisis we cannot yet imagine, some future policymaker will face a choice similar to the one faced in 2024. Close the markets or let them crash. Intervene or let creative destruction run its course. Play for time or accept immediate pain. And that policymaker, no matter how much they have studied history, no matter how many lessons they have learned, will face the same fundamental uncertainty. What is the right decision when all available options are terrible? That is the final lesson of the year-long closure. Not that we need better regulations or smarter policymakers or more robust systems, though all of those things would help. The lesson is humility, the recognition that we have built systems of such complexity that they can fail in ways we cannot predict, through cascades we cannot control, with consequences we cannot fully anticipate. And when those failures occur, when the next black swan appears, when the next crisis demands a response, we should approach our interventions with fear and trembling, knowing that the power to pause markets is also the power to damage them, perhaps irreparably.